Welcome back to Investing Talk Podcast.
Today we're looking at Open Door Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's. Because this company is just... it's a fascinating paradox right now.
It really is. And I think to understand it, you have to start with the financials. You have to see just how tough things had gotten.
Right. The traditional iBuying model got hit hard.
Brutally. I mean, just look at the 2024 annual revenue. It came in at $5.15 billion.
Which, on its own, sounds like a huge number.
It does, but it's the context. That was a drop of nearly 26% year over year.
Oof. And the losses, I'm guessing they're not pretty.
Not at all. The trailing 12 months net loss is sitting at around $317 million.
Wow.
Yeah. These aren't minor dips, you know? These are the kind of numbers that force a company to make some radical changes.
Absolutely. That's not sustainable. It's basically open heart surgery time.
Exactly. And the preliminary Q3 numbers, they just underscore that pressure. You've got revenue of $915 million.
What?
But that only generated $66 million in gross profit. So the margin is, what, 7.2%?
It's thin.
Very thin. And the net loss for that single quarter was still $90 million. They couldn't keep bleeding cash like that.
Which brings us to this big strategic shift everyone's talking about.
Right. This pivot to an AI-driven asset-light model.
Okay, so let's break that down. What does asset-light actually mean here?
It means they're trying to get away from holding so much inventory. The old model was so capital-intensive, you know, buying homes, holding them, being exposed to all that market risk.
Sure. Interest rates go up and you're stuck.
Precisely. The new model uses AI to, theoretically, price things better and faster, and more importantly, to shift that capital burden away from Open Door itself.
So it's a move from being a real estate company to being more of a tech platform.
That is the goal. If they pull this off, the margins could improve structurally. And that's the whole bull case, really.
And some of the big firms are starting to buy into it, right?
They are. I mean, we don't have hard proof in the quarterly results yet, but you have analysts, like at JP Morgan. They're already modeling the company to hit break-even by 2026.
2 years out.
Yeah.
That feels both optimistic and...
yeah.
a long way away.
It tells you two things, right? First, that this is a really difficult, slow turnaround. And second, that the market seems willing to give them a bit of a leash, a bit of runway to prove it can work.
And a big part of that, I imagine, is the leadership change.
Oh, for sure. You get a new CEO, and that alone is a huge signal. But then you also had that insider buy.
The CEO bought shares.
Yep. 125,000 of them on November 11th. For a stock this speculative, that's a really powerful indicator. It says the person at the very top believes in the story.
But belief doesn't fix a balance sheet.
Right.
Which is where this massive capital markets shakeup comes in.
Correct. And this is where things get really complex, but you have to understand it to get the full picture. This wasn't just about raising money. It was a complete overhaul of the company's structure.
These were some bold moves.
They were. And the result is, frankly, huge dilution for existing shareholders. It's a trade-off.
So what were the first steps? I know things started moving back in September.
Yeah, that was kind of the prelude. They did some smaller deals first, stock purchase agreements with big investors like Khosla Ventures.
Okay.
And they also completed an ATM program, an at-the-market program.
Right, where they can sell shares into the market over time instead of all at once.
Exactly. That brought in about $198 million in cash from issuing another 21.5 million shares. But that was just the warm-up act.
For the main event in November.
For the main event. A registered direct offering of over 180 million shares.
180 million. That is a ton of new equity hitting the market.
It's massive. And here's the really clever or, complicated part. At the same time, they agreed to repurchase about $264 million of their 2030 convertible notes.
Okay, so just make sure everyone's following. A convertible note is basically debt that can be turned into stock later on, right?
That's it, exactly. It's debt, but with an upside for the lender.
Right.
So Open Door sells all this new stock.
A lot of new stock.
A lot of new stock. And they immediately use a chunk of that money to buy back this convertible debt. It's essentially a big debt for equity swap.
So the whole transaction was valued at, what, $1.2 billion. Yeah. But the company said they'd have no net cash change.
Mm-hmm.
That part seems counterintuitive. Why do that?
Because it wasn't a cash grab, it was a balance sheet restructuring. They were choosing long-term stability over short-term cash.
Yeah.
They're cleaning up the liability side. swapping out debt that could cause problems later for dilution right now.
Uh-huh.
It strengthens their foundation while they try to pull off this big AI pivot.
Makes sense. They're making sure they don't drown while they're learning to swim a new way.
Perfect analogy. But it brings us back to that cost you mentioned, the dilution. We were already at, 772 million shares outstanding in October. This just sends that number way, way higher.
And that's before we even talk about the warrants.
Right, the warrant dividend, which is this interesting tool they use to sort of reward shareholders for putting up with all that dilution.
So a warrant is basically a long-term option to buy the stock at a set price, right?
That's it. And Open Door distributed these warrants with 3 specific exercise prices, $9, $13, and $17.
Which is pretty fascinating. Those prices almost feel like a roadmap for management.
It's exactly that. They're basically telling the market, we think our stock can get here, and if it does, we'll get another injection of capital when you exercise these warrants. It's their own belief system baked right into the stock.
So all of this massive overhaul,
Right.
it leads us to this huge contradiction.
The gulf, yeah, between the stock's momentum and its actual, fundamental reality.
The technical side is it's screamingly bullish. The stock is up, 430% year to date?
It's absurd. This is one of the biggest meme stock stories of the year. It's all retail sentiment, short squeeze talk. It has very little to do with the company's current P&L.
And you see it on the charts everywhere.
Oh, absolutely. It's trading above all the major moving averages, the 21-day, 50, 100, 200. That's just a sign of broad, sustained upward momentum.
So what are the key levels you're watching?
Well, short term, it's been in a range between about $7.41 and $8.96. That $8.96 level is the big resistance. If it can break through that, you could see another really powerful run.
Okay, so that's the momentum picture. But then you turn to the analysts.
And it's like a different planet. It's jarring. The consensus rating is still a sell.
A sell, even with that kind of price action.
A sell. And their average price target? It's $1.88.
Wow. That is a massive disconnect from where it's trading now.
It's a chasm. The stock is trading at more than 4 times what the fundamental analysts think it's actually worth. They're looking at the cash burn, the execution risk, and they're basically saying this price action is irrational.
So what does that tell you about the company's moat, so to speak, its ability to defend itself?
It tells you the moat is being tested, maybe even compromised. The price is all about the narrative, the bet on the AI pivot. The analysts are still looking at the core business, which is losing money in a tough sector. They haven't validated the new model yet. Not even close.
Which means if you're an investor, you really need to be watching the calendar right now.
You have to be glued to it.
Yeah.
These capital moves have created a schedule of high-stakes events that are going to drive a ton of volatility.
So what's coming up?
Well, we just had November 18th. That was the record date for the warrant dividend.
Okay.
Then the big one is November 21st. That's the official closing date for the offering and the note repurchase. That's when that whole $1.2 billion transaction settles.
And a flood of new shares and warrants hits the market.
Exactly. Expect a lot of activity. Then you look to mid-December, around the 15th. That's the ETF rebalancing window.
The funds will be adjusting their holdings.
Right. And then at the end of December, we get the 13F filings, the institutional disclosures. That's when we'll see which big funds actually bought into this offering. That's the real confidence vote.
And the next earnings report isn't until next year.
Mid-February 2026. That will be the first big chance for management to show some real data on how this new strategy is actually working.
Beyond those hard dates, there are always rumors swirling around a stock like this.
Always. And some of them are pretty enticing, even if they're unconfirmed.
Like what?
Well, the big one is that it could be an acquisition target. Think about it. A larger tech company, or even a Zillow or Redfin, could buy Open Door and instantly get all that data and infrastructure.
That makes a lot of sense, actually.
Then there's the talk about a partnership with a fintech company to offer mortgages. That's the quickest path to improving margins on each transaction.
Right. Add-on services like title, mortgage, escrow.
Exactly. And the last rumor is geographic expansion. Unconfirmed reports that they're looking at 2 new metro areas for early 2026. If they can scale a successful AI model quickly, that would be a huge catalyst.
Okay, so there's a lot of potential upside, but let's balance this out. We have to talk about the risks.
We have to. And they are very real. The number one risk is just execution. This pivot is a total refounding of the company. It's not a software update.
And it's totally unproven.
Totally. If it doesn't deliver the profitability they need, the stability they just paid for with all this dilution could just evaporate.
Then there's the housing market itself.
Yep, industry volatility.
Okay.
They're trying to be asset light, but they're still tied to the housing market. If rates spike again or home prices fall, the whole sector gets hurt.
And the last one is obvious, I think.
The meme stock factor,
Yeah.
the market risk. This stock is flying high on sentiment. If that sentiment shifts, the price could fall back toward that analyst target of, under $2 really fast.
So putting it all together, what's the thesis here? How do you rate it?
I think for a certain type of investor, a highly speculative one, it's a powerful bullish story. I'd put the speculative rating around a 7.5 out of 10.
That high, even with the losses.
Yeah, because the technicals are just so strong, the charts are showing a durable trend, and for traders who know how to play volatility, there are clear entry points.
And the long-term bet is all about that AI strategy.
It's all about that. If they execute, they come out of this with a much more defensible, scalable business model than their competitors, a model with like risk.
So it sounds like this is a stock for two very different kinds of people.
I think so. First, you have the short-term traders playing the volatility around these catalyst dates. And second, you have the speculative long-term investors. And they're not buying the current business, they're buying the turnaround story. They're betting on the 2026 vision.
So the company just paid this enormous price, all this dilution, to buy itself more time. The question is, what do they actually buy?
That's the perfect way to frame it. Did that massive capital raise just buy them time to survive a little longer, or did it truly guarantee their transition to this new AI-powered model? The real tell won't be in home sales next quarter. It'll be in those institutional holdings disclosures at the end of December. That's when we'll see if the big money truly believes in this management team and their vision. That's the real vote of confidence.